GST Council will discuss reducing items in 12% slab. TCA Sharad Raghavan, New Delhi. The agenda for the Goods and Services Tax, GST, Council at its next meeting will include deliberations on minimizing the 12% tax slab and also finalizing the tax treatment on service intermediaries, which could provide the sector relief worth thousands of crores, according to informed sources. The meeting was initially supposed to be held in June. There has been some back and forth between members of the Council over the location of the meeting, leading to delays. It will now likely be held in July 2025, which will be more than 6 months after the last meeting. According to the rules, the GST Council is meant to meet once every quarter, or 3 months. One of the main agenda items, as part of the overall simplification and rate rationalization effort, is what to do with the 12% slab. An official aware of the developments told The Hindu. One of the internal recommendations was to minimize the slab or maybe even do away with it entirely. Service intermediaries. The Hindu has learnt that the other major item on the agenda of the GST Council would be the taxation of service intermediaries. Currently, service intermediaries are taxed at 18% even when they provide services to companies abroad. This is likely to be removed. Doing away with the 12% rate would reduce the number of tax rates under GST to 0%, 5%, 18%, and 28%, not counting the specialized rates of 0.25% on diamonds and 3% on gold and silver, or the additional compensation cess on items in the 28% slab. It is improbable that the GST Council will completely abolish the 12% tax slab, Saurabh Agarwal, tax partner at EY India, explained. Instead, they are likely to gradually reduce the number of items in this category by shifting them to the 5% slab. Additionally, some items currently taxed at 18% may be moved to the 12% slab. This adjustment would reflect a change in consumer behavior, he said, since rising per capita income meant that many products that were once considered discretionary, such as toothpaste and soap, have become everyday necessities. Currently, toothpaste and soap are taxed at 18% and shampoo can be taxed as high as 28%. However, other tax experts say that moving items from the 12% slab to 5% might not always be a good thing for the manufacturers. At 12%, they are eligible for input tax credit, which will likely be revoked if they are moved to 5%. This means the manufacturers would not get credit for the tax they pay on inputs.